What's up, guys? Welcome back to the channel. Today, I'm giving you a mechanical trading course. This course is going to cover everything that you need to know about mechanical trading. So let's get started. So what am I going to talk about? First of all, what is mechanical trading? What are the benefits of mechanical trading? What's the downside of mechanical trading? Mechanical trading setups and questions at the end. So let's dive into today's session. First of all, what is mechanical trading? You hear me speaking about this all the time, that I trade mechanical and that I like to trade mechanical, but what actually is mechanical trading? First of all, mechanical trading consists of black and white rules. And most people think they have black and white rules, but when I ask them, like, can you backtest this? Can you automate this? Then they're like, no. And then I'm like, then you don't have black and white rules. Black and white rules mean the rules are so clear that there is no guesswork involved when you're trading the edge and that it's programmable. That's mechanical trading. And the thing is, most people think they trade mechanical, but they actually trade rule-based. And rule-based and mechanical trading are kind of similar, but rule-based trading means you have rules, preferably written down rules. You can follow the rules, but the rules are not programmable into a robot. And that's the difference between mechanical trading. Mechanical trading is so black and white that it's like, if price breaks below X, do ... do the next step. It's very, very black and white and can be programmed. If you trade rule-based, that can be discretionary, but in a very rule-based way. For example, I'm going to buy a retest of a breakout if it has 3 touches. Now you cannot, or maybe you can if you're a pro, but usually you cannot quantify, you cannot program 3 touches into an EA. But if you look at a chart, you can see if there are 3 touches. So it's rule-based, but it also uses a bit of your discretion to determine what are 3 touches. And if you train your eye, you can be good at it. And rule-based trading is definitely a great way of trading. I prefer mechanical trading because it doesn't involve guesswork. If you have 3 touches, sometimes, let's say your chart looks like this and you get a breakout and your rule says to buy a breakout of 3 touches, to buy a retest of 3 touches. Now, do you count these as 3 touches, or is this one a bit too far away? With mechanical trading, you don't have that issue. With rule-based trading, sometimes you can have that issue, and then you really need to be clear, all right, what do I count as 3 touches? That's the difference with rule-based and mechanical trading. Both ways of trading can work. Even if you trade fully discretionary, they can also work. Mechanical trading is my style, and it's completely rule-based without guesswork, and it can be programmed. Now, if we take a look at what are the benefits of mechanical trading, it is very, very clear. And benefit number 1, it's easier to backtest. If you have very, very clear rules, it is very easy to backtest the strategy to see if it had any edge in the past. If you're trading fully discretionary, you can't really backtest. If you trade a rule-based system, but that's not mechanical, you can still backtest, but it's also is a bit more difficult than when you have a fully mechanical system. And let me give you an example, because a lot of people these days trade smart money trading and smart money concepts and institutional trading and those type of things. Now, I truly believe that a lot of approaches can work and can make money in the markets, but if you study smart money trading, it's very subjective. And because it's so subjective and because you learn concepts, you yourself need to build rules around it to backtest it. And if you have a mechanical strategy, that's way easier. But if you have such subjective strategies, and I've spoken to a lot of people about this, even people in Zoom calls that book a free call with me and that want to know more about backtesting. And then they tell me they trade smart money. And then I'm like, oh, damn, dude, that's so complicated for most people because it's too subjective. And that makes it so hard to backtest it. And also, there's so many things to consider. And I always tell people, just keep it simple. When you trade smart money, you have like 10, 15 different concepts. And like, just pick one or two concepts that you really like, build rules around it, and then start backtesting those. And later on, you can add things if you want to, but it doesn't have to be added in the beginning, because it might seem very overwhelming if you start with like 15 concepts to backtest. But if you have one or two concepts with a few rules and you just backtest, I don't know, 10 trades a day, at the end of the month, you have 300 trades backtested. And it's very nice progress. So mechanical trading is just easier to backtest, and it's easier to execute in live markets because you just have a few rules that you need to follow. And it's either it's yes or no, guys. It's no, maybe a gray area. There is no gray area in mechanical trading. It's yes or no. You enter a trade that follows your rule, or it doesn't follow your rule and you don't enter a trade. That is mechanical trading. For me, it really, really fits my personality because I'm like that in real life. I'm not a maybe guy. I like things to be clear. It's either yes or it's no. I like to have structure in my days, in my life. And that's exactly what I have in my trading. And that comes back to finding trading that fits with your personality. If you're someone that likes structure, and it's like me, that's very not a maybe guy, if I explain it like that, then mechanical trading is definitely going to benefit you. So it's easy to execute because there is no maybe. You see a setup or it's not a setup, and then you can just take the trade, follow your rules, and that's it. With rule-based trading, like I said in the beginning, there can be more discretion that makes it a bit harder to execute. But I would say even rule-based trading is definitely for most people better than discretionary trading. And one thing I would like to add here is that I believe that in the beginning, so for beginners, mechanical trading or rule-based trading is the best way to go. And why? It's because you need to get into the habit of following a plan over and over again. And if you trade mechanically, it's very easy because you essentially, you tick boxes. You're like, all right, yes, that works, that worked, that works, and trade. Excuse the drawing, but that's how it works with mechanical trading. And if you do this month after month after month, you get the feel for following a plan. But if you trade discretionary, there can be a plan, but it's harder to develop this. Now, I think most people should start with mechanical trading or rule-based trading, and then they should, along the way, they should figure out if this is really what fits with their personality. And then later on, you can add discretion and other type of things. But if you start with mechanical trading, it is easier to backtest to see if there's an edge. It's easier to execute in the markets to build a habit of following a plan. And it is easier to improve. And then later on, when you've been trading the mechanical strategy for a few months, you can think, all right, do I like this? Do I want to add a bit of discretion? And that's where your journey really, really begins. So why is it easier to improve? Because you have black and white rules. And if you have black and white rules, you can have reliable data. And if you have reliable data, you can really analyze, all right, for example, I noticed that after I buy, price tends to move 50% to my stop loss. Then you're like, okay, then I'm going to move my stop a bit up, and I'm going to increase my entry accuracy to get a better risk to reward ratio. This can be done with other types of trading, but with mechanical trading, it's just easier because the rules are so clear. Now, let's talk about the downside of mechanical trading, because it's not all sunshine and rainbows with mechanical trading. And it's with every way of trading. Every way of trading has its pros and cons. And the way of trading you pick, the pros of the way of trading you pick has to fit with your strengths as a person. So that's very important. But what's the downside of mechanical trading? First of all, it tends to not maximize performance. And why is this? Now, basically, if you trade fully mechanical, like I used to start off trading fully mechanical, and I quickly noticed that before I entered, because I had a lot of experience with the markets already and with my strategy, after a while, I started to notice that when certain things aligned, discretionary things, my performance would lag. So before I would enter a trade, I already knew, all right, this, and this is happening. That means it looks like shit. And that means, based on my journal, that the performance is going to be worse on this particular trade. And if you're trading fully mechanical, you're like, fuck that, fuck my journal, or fuck how it looks, fuck the discretionary part. I'm just going to follow the rules. And yes, it can make money if you back tested it, but it's not maximizing performance. And that's where I really worked on the last year of trading my mechanical strategy. I've been trading it for years right now. So after a year, I was like, all right, it's profitable and it's working well. I've built a habit of following rules. I've back tested correctly and it's making me money. But then I started to dive into my journal and I started to look, all right, but I've noticed things that happen when I'm trading this strategy. I've noticed things that when certain things align, the odds of winning decrease. And that's where I added discretion. So now I have the best of both worlds. I have mechanical trading for structure, easier to backtest and easier to journal, easier to execute. And I do add a bit of discretion to maximize performance. But I can only do this because I have a lot of experience with my particular mechanical strategy. I know when it tends to work. I know when it doesn't tend to work well. And because I've been trading for so long and seeing setup after setup after setup after setup, I know when certain things align, the odds of winning increase. That's where I add a bit of discretion. And that's where I maximize my performance. So if you trade fully mechanical, it tends to not maximize performance, but it is profitable. Another thing is edges might go away quicker because it's programmable. It's easy to pick up for other people. If you trade fully discretionary, it's very, very hard to find someone's edge. And usually the guy that trades is the edge. But with mechanical trading, it's really the strategy that gives the edge. And these edges tend to go away quicker, and it might scare you, but it's not really a scary thing, because if you just continue to learn and if you continue to backtest and journal just every single month, you can keep improving. So when your edge might perform a bit less, you already have 1 or 2 ideas that can increase its performance. And also, when you're just starting to add a bit of discretion, like I do, after you have a lot of experience with the strategy, your strategy also tends to become better, and it becomes harder for them to go away. But strategies definitely go away. I spoke to a friend of mine. He backtests like so many systems, and he's like, so many work for a year, 2 years, and then they just lose, and they turn to shit. It happens, guys. It's a real thing that edges can go away. So if you have a profitable strategy, don't just sit there celebrating, drinking cocktails and clicking buttons to make money trading. You found a working strategy, you found your edge, that's great. But you have to keep improving, because it can go away. And there's nothing worse than your edge going away, because then you don't have a way to make money again. And then you have to start again, probably, or you have to find ways to improve your edge. So if you are one of the few that made it to become profitable, work on your edge. I'm working on my edge every single day. If I open my schedule on my laptop, you can see every single day 1 hour is planned in to edge improvement. And sometimes it's 2 hours. It's just me going into my journal, me backtesting stuff, always finding things to improve. And if you do that day after day, it's very hard for your edge to go away. So that's what I wanted to talk about in terms of the theory. Now I want to dive into mechanical trading setups, and I'm going to give you a few examples of my mechanical trading. Not giving my edge away, of course, and that's for my clients, but I can explain what goes behind it and how I build my mechanical trading strategy. So first of all, what goes into my mechanical trading strategy? Wyckoff accumulation and distribution. And if you've been familiar with this, with Wyckoff accumulation and distribution, you know it's subjective. You know it is about a bigger player establishing a position in a range. And then you might be thinking, all right, but how is this range mechanical? The range can look like that. How is that mechanical? I will get into this. I've made clear rules that can be programmed to quantify accumulation and distribution. I also include absorption of liquidity. So that's what's inside my strategy as well. And again, I made it fully mechanical so it can be programmed. I basically quantified a false breakout. So if this happens, then we have a false break, and then I wait for a real breakout. And that's it. So I wait for accumulation or distribution, absorption of liquidity, and then I wait for a real breakout after a false breakout. And I made that mechanical, so it's easy to follow. It was very easy to backtest. And now I have a very nice edge. So let's go to the charts and give you a few examples. All right, so we're looking at the charts, and I'm going to explain 3 mechanical setups that I took, and I'm going to show you the power of mechanical trading. These are hindsight examples, but these are trades that I actually took, believe it or not. And I'm going to explain exactly what goes on behind the setup, but also where I entered, stop placement, and those type of things. Now, in the presentation, I explained that I basically quantified the Wyckoff method and absorption of liquidity, and I combine it with a breakout. Now, I use this in various different ways. First of all, it is in the setup, but I also use it as a bias. Now, if we go to the daily time frame, and if we take a look at what happened here, this swing low is the origin of this up move. And if we take a look at what happened, we took out that swing low and quickly rejected. So people that had the stops here or that wanted to sell in this area all got trapped. Now that does give me a bullish bias. And then if we go to the hourly time frame, we can see, if you're familiar with Wyckoff, we have a clear accumulation range in this area. It's not a textbook example, but 3 lows, 3 new lows, and then quickly rejecting is a form of accumulation. And then we break structure here. We go down and we don't make a new low, and then we break it again. This confirms to me that this is our accumulation range. We broke out, we retested it at the area I just showed you on the daily time frame. So that gives me a stronger bullish bias. Now, if we then take a look at what happens, is that this spike takes out all these unbroken lows. So if people were smart enough to be buying, that's a shit arrow, to be buying in this area, they tend to place the stops below key swing lows. And those people all got stopped out with this spike down. And then we went up and again broke structure, went down to retest, and then we went up. So this all gives me a bullish bias in terms of market structure, but this is not mechanical. And you're probably thinking, dude, this is just discretionary trading, maybe rule-based. But then we come to my setup, and the red line is my entry. I went long. This is my stop, and this was my target. Now, this is all mechanical. I'm not giving you the rules for this target placement, but it's either a yes or a no, and then the line goes there. It's the same with this entry. It's just a few questions, and if they are all answered with yes, then my entry goes there. Same with stop. So this is my mechanical strategy. I'm going to show you my statistics for this. Whoops, let me check. There we go. Right, so this is my backtested spreadsheet in the USD Canadian. And again, this is fully mechanical, guys. This is not with discretion or hindsight. This is fully mechanical. And I've backtested this over a lot of data. If I go back 2013, January until now, 21st. And this shows me that I have an edge if I take this setup over and over again. So if we go to the chart again, and my long entry was in this area. Now, to explain to you the concepts behind it. So I said Wyckoff and liquidity. This is clear Wyckoff reaccumulation. We have our low of the range, then we have a clear spring, and then we have our breakout that I spoke about. This is exactly what I spoke about in the PowerPoint. We have our range, liquidity absorption at the low end of the range, and then we have a violent break of structure. This is exactly the concepts that I use in trading. And a lot of people use these concepts, but they use it too discretionary, in my opinion. And I made this fully mechanical. This is the data to back it up. Now, if I fill in these statistics, there was a 64% chance of hitting that green line before taking out my stop. And if I put a fib tool over it, you can see it's around a 1.5 R. So I win more than when I lose, and I win more often than I lose. So that's a great edge to have. And this is fully mechanical trading, but with the underlying concepts of Wyckoff accumulation, liquidity absorption, and then entering at the momentum breakout. So that's just an example. The reason I explained about this accumulation range before is if those type of things happen before I get my setup, I know the odds of winning do increase significantly. So it was higher than this, but that's a bit of a discretionary part. And I didn't backtest it, but I did journal it for years, for around 1.5 years, I have to say. And I just noticed it over and over again that if I have certain things in terms of an accumulation bias before I get my entry set up over here, the odds of winning increase. And then I got my entry setup happening here, again, fully mechanical. It tells me I should enter here. It tells me my stop should be here. It tells me my target should be here, and target has been hit. Of course, I don't win every time, of course, but I just wanted to show you this clean setup. Now let's dive into the next one. All right, so we have another setup in the USD Canadian. I don't only trade the USD Canadian, but it just often gives clean setup. So that's what I wanted to show you guys, that it can be very clean. So again, I went long, and I went long on a red line, target here, and stop here. Now you might be thinking, why on earth would you be buying here? Because I bought in this area. This is an accumulation range, guys. It's a selling climax, move up, range forming, taking out the low end of the range, and then we break structure here and we break structure here. And I entered here because this was the significant structure. Again, it sounds discretionary, but I have very mechanical rules for this. And to most people that use technical analysis, they're like, Jesus Christ, why are you buying up there? You got this swing high. Let me clean that up a bit. You got this resistance swing high here. We do a false breakout. So price tends to move to the downside after a false break. Why on earth would you be buying up here after such an impulsive move? And I do get it, because it seems like a weird thing to do. But again, if you have back tested your edge, and in my case, a mechanical edge, which makes it easy to back test, you just know where to enter. My rules just tell me enter on the red line. My rules tell me place your stop here. And my rules tell me put your target here. Now, price went up, almost hit target, then fell back down. I don't manage my trades. So I was in the trade during this, during this, during this, during this. And then again, here we got the same thing that I always look for. False break of the lows, false break of the lows. So it was at this candle that I was very, very confident that my target would be hit. And I did get a fill in this particular area. So again, if we take a look at what happened, we had our accumulation range. Low has been swept, break of structure, break of structure. That's a real breakout to me. And I enter at the momentum breakout. Fully mechanical, again, the statistics were the same on this trade because it was the same setup. And it sounds boring, but I just take the same setup over and over again, guys. So again, 64% chance of hitting target. And if I draw my FIB tool over it, it's around a I'd say 1.3 R. So risking 1 to make 1.3 R, again, winning a bit more than when I lose, but winning way more often than losing. And that's it. Again, the same odds, the same underlying principles, which is an accumulation range and a momentum breakout, the same rules. Sounds boring as fuck, but it does make me money. Let me give you one more example to really show you the power of mechanical trading. All right, so last example, and again, and look at what we have here. Wyckoff distribution range, equal highs. We take out the equal highs, and then we break structure here violently, and we break structure here. I took a short trade in this case, and again, it's a winning trade, but I don't always win. These were just very clean setups. So target is here, fully rule-based, entry red line, stop up here. And as you can see, guys, it's just over and over again, the same thing. In this case, the odds were a bit lower. If I go to my statistics, it was a almost 58% chance of hitting targets. So I'm going to fill that in. Oops, spelling mistake, but it doesn't matter. Putting a FIB tool over it, it gives me around a 1.2 R, I would say, eyeballing it. So again, winning a bit more than when I lose and winning more often than losing. And that's it, guys. That's really the power of mechanical trading. I have underlying concepts of a bigger player absorbing liquidity above equal highs. And then I wait for a violent breakout of structure. I enter there. I don't wait for any retest at all. And again, I was in this trade the entire time. So even when it went close to target, I didn't take profits. And then again, highs taken out and we fell down. And at this point, I was quite sure we're going to hit my target. So Wyckoff, liquidity absorption above the highs, and my violent breakout, all made in a very mechanical way. I can even program this strategy, and that's what you want. That's real mechanical trading. If you cannot program a strategy, then you're trading systematically, in my opinion, which is not mechanical trading. I spoke about this during the presentation, but I can automate this strategy. I don't want to, because as I said earlier, I do add discretion in terms of my risk. So I really like to keep that part to myself to maximize the performance of my edge. But this is the power of mechanical trading, guys. It's the same thing I do over and over again. I just have a sheet in front of me with my rules. And I just wait, does number rule fit with the chart? Yes or no? Yes, it does. Next question, does it fit with the chart? Yes or no? Yes. Then put line here. I put line here. Next question, if that's the case, I put line here. And that's it. Boring as fuck. And I might be the most massive geek in terms of trading. But it does make me money and it does work. And this is mechanical trading. This is how it works. Most people will tell you to trade mechanically, but then they just trade very rule-based, not mechanical. Oh, but this is the power, and I've been developing this over and over again. If you've been watching my channel for a long time, you know that I started off around 5 years ago with the Wyckoff method, and I'm still trading it. But back in the day, I traded it very discretionary, and it didn't fit my personality. And I found that out 2.5 years, maybe 3 years later, that I did like the concept, but it didn't fit my personality, which made it very hard to trade for me. And then I really started to dive into how can I make this fit my personality. Then I came across mechanical trading, build a fully mechanical system around the concepts that I already knew. And that's how I developed this edge. And this is the edge I teach all my coaching clients. So hopefully this was clear and you now know the power of mechanical trading, you know the benefits, you know how to improve it once you're profitable with your edge. And hopefully maybe you think for yourself right now, like, oh, that way of trading really does fit with me. And hopefully I spurred you guys on to do some homework and what you actually like in terms of a strategy, and then start building one. So thanks for watching, guys. If you have any questions, comment down below. If you have any, I don't know, if you think this video was shit, also let me know. And then I see you in the next video. Thank you.